So welcome everybody. It is 3 o'clock or 3:02 here, and it is May 1st, first day of May. So thank you everyone for being here. I am looking forward to a great session, and it looks like the market is down a bit right now. It's been down all day, so it's been kind of a little bit of a pullback. And for anyone new here to how do you get your questions answered, just please enter your questions into the questions section, and then I will be able to read it and then reply back to you. So that's the most efficient way to for me to get everyone's questions, and I can share all the questions as needed back and forth with everybody. Okay? So let me just get through this really quickly. I'm not here to give you any advice, any recommendations on your trades, and I am not a broker. So I'm not here to solicit any accounts, just to give you education on how to trade, how to set up trades, and how to logically place trades to profit, and also take our losses, right? It's important to book our losses and book our profits. So that being said, if anyone has any questions, they can always email me at ralph@omegatrades, and I will be happy to answer those questions for you. And also, you can check out the website at omegatrades.com, or give me a call here at the office, whatever works for you, right? So, that being said, let's look at our watch list. Let's look at the market. Let's look at where we're going and what we've got going on. SPY. Always like to, why does it do that? SPY. So you can see this beautiful, beautiful uptrend, folks. Is there anyone in the audience, just out of curiosity, anyone in the audience that would tell me that this is not in an uptrend? Anyone? Or does everyone at least can agree with me that this is what we can define as an uptrend? So yeah, okay, I'm not getting anyone telling me otherwise. So safe to assume that this is what's considered a intermediate and long-term uptrend, and even in the short term, we've got a uptrend. Okay, so look, the market has a pullback today, a pullback to an area of support. Right here at the 158 and change level of support. Now, if this thing does get a little bit of a bounce here, we're going to see a resistance breakout. Okay, so there's definitely an uptrend intact. One day does not make a trend. If anyone's ever curious about trending, one day definitely does not make a trend, right? So today is just a slight little pullback. If we look at the Qs, the QQQQs, hey, Paul, great to see you. We can see that the Qs just yesterday broke out of a really significant area, broke out of a resistance line here. And that resistance line at the $70 and mid 70 range, and we're holding it today. We're actually holding above, even though, you know, it's a down day, we're holding above that resistance break. That's an encouraging sign for a possible, you know, next, what we call a trend continuation, okay? And the IWM, oops, the IWM, the Russell 2000 ETF, you can see this is the one that's relatively gone a bit sideways lately, okay? I'm not going to say that this is what's causing the market not to really scream higher. It's a lot of things that's really there, but this is a little more of a sideways trend, and because of that, I'm intrigued to maybe look at a sideways trending trade that we could put on. So we're going to talk about that as well. Okay. Now, as for a few questions that I have received via email, one of the gentlemen I know emailed me that he couldn't be here to get his questions answered, but I can still hopefully get his question out there when he does the replay. But I did have Mike's question here. He's a big selling puts guy. And I love selling puts. I think it's a great strategy. And so with selling puts, you've got to either want to own the stock. You want something that you think it's going to be above or stay sideways. It's going to either move up or go sideways. So some of the stocks he's looking at for selling puts would be, one of them is Facebook, so it's at least going sideways. I'm just going to look really quickly at the charts themselves. FNSR, a little more of a choppier stock, but it's up. That's trending up. Oh, that's not the right one. FNSR. There we go. Okay, so FNSR, that's the other one. Not a big fan of this one because it is downtrending. It is sitting at support, so that's at least one encouraging factor. I don't like downtrending stocks to sell puts. If it holds support, then I'd be encouraged to think that this is something to at least see about getting involved in. But a downtrending stock is my first inclination of not selling a put. So my first criteria isn't passed. It doesn't say I'm not going to place the trade, but my first one is a big one. JDSU. This one is a little more of a downward trend, more sideways to downward trending. So it possibly has a little bit of a run back down to about 1230. So I'm not. Let's see again on this one what the premium is and what our break even would be. But I like things that have some tilt to the upside, to even sideways is okay. But when they're tilting down, the probabilities that I'm going to be wrong increase. Right? So I'm not a big fan of having, when I'm selling puts, folks, I want high probability. So I need to put everything in my favor to have the biggest probability to be right, because the trade is going to be a trade that I'm going to risk more to make less, and high probability is really good. Well, selling calls, yeah, Jerry, that's a great idea if you're going to sell calls. The whole idea was setting up someone's questions for what he wanted to do, which was selling puts. So here's another one, FIO. So now what I want to do is, on these stocks, let's go look at a trade page, and now let's dovetail. Let's detach this, and let's bring over the hold on one second. Let me. Did it do it? No, it did not. There we go. Okay. So let's bring this over. This is the trade page. Oops. All right. So let's go take a look at what some of these options would be next to the chart. And we'll kind of just look at the right side of the chart there. And since we've got this one up, let's start with this one. This one is the FIO. And so FIO. Let me put FIO in here. Let's see what the premium is going for. Selling, well, May is pretty darn close. So, between May and June would be what we're looking at here. It's a $17 stock. 10% is $1.70. 5% would be, 80 cents. So, we'll put it this way. 1% is 17 cents. So, I need to get like 50 cents in here. And so the 16 does give me 55 cents. And it's got a 26 delta, which means I've got about a 70% probability of being right. Right? Okay? But that means that my support line means that $17.50, $16 minus the 50 cents I create, so $15.50 is where I'd be at break even. So I see support at 1550, and I see support at 1764. Premium's okay, the probabilities are okay, but the slope of the stock and the direction it's going is not. So not something that I'd be willing to put on as a trade. even though the premium is okay, it's not overwhelmingly. Uh, if I was going to collect a dollar on this, which would be ridiculous, then I could say, all right, you know what? There's so much premium that it might be worth it. JDSU, and that's not going to say that these aren't going to be profitable trades. I can be wrong. They can be profitable. I'm just thinking the highest probability. Okay, the highest probability of being right. So here's JDSU, very cheap stock, and I can already tell you right now, it's not even going to be worth it because you're not going to collect a lot of premium. I would be looking to go a couple strikes in the money, and 24 cents. That's like 2%, which is usually an okay thing, but it's just, when you think about the cost of your trade and your risk, if you're going to spend $3 to $4, even some people $10 to get in, $10 to get out, this is not even something I want to touch with a 10-foot pole. Even if you're going to spend $5 in for your trade and $5 out, on one contract, you're even $3 in, $3 out. That's $6 that you got to spend on this trade. You're only going to make 19 cents, 20 cents. So yeah, it's the premium there isn't worth it either. Sure, absolutely, Paul. I just saw that. So yeah, I can let me get rid of this and let's make this bigger. There we go. So Paul, the question from Brian comes in about what percentage do you look for? Well, in terms of how much, I really like the 3%, 4% of the strike price. Right? That's kind of my go-to preference. So when you think about that, when you've got a stock that's at like $12.88, if you're looking at that 11, 1% would be 11 cents. So 2% would be 22 cents. 3% would be 33 cents. Obviously, this one's pretty easy because it's at 11. But I really like 3 to 4%. That's my absolute preference. If I go down to 2, I'm okay with that, Brian. But it's got to have a lot of things in its favor, and these two both don't have a lot of things in its favor right now. You can see the first, they're tilted to the downside, or there's at least a bearish bias on both of them. Let's go to the other one that Mike brought up, which is FNSR. And this is another one that's kind of got this downward tilt as well. So I can again look this up. It's not going to negate the trade, but FNSR. Again, I'd be looking at that. I want to get that mid 20 delta, and I'm going to get 40 cents. So here's about 3 to 4%, which is okay, which is my what I prefer. Strike price, Brian. Let me put that back in so people can see what you replied. So I would really prefer to get the 3 or 4% of that strike price. And so again, I've got a downward tilt to it. So to get my ideal price is great, but then I've got that downward tilt. So of the 4 so far, the first 3 I'm not really in favor of. Facebook has got earnings coming out. I believe they've got earnings coming out pretty darn soon. So that would be a concern for me is jumping in front of earnings. Selling puts is not something that I want to do before earnings. Thank you, Michael. Appreciate it. So tomorrow, Facebook is a little more ideal, Mike, because it's got a sideways trend. Now, with Facebook, though, what I do find intriguing is that if you wanted to kind of take advantage of maybe a little pop in volatility for the earnings, let's take a look here. You can see how much volatility are in these options here, right? There's 118% volatility in this option because today is earnings. So what's very interesting about that, let's just look at the near-term options. And look, folks, also remember, if I'm talking about something you don't understand, please make sure that you hit me up with a question that you don't understand what we're talking about. So look at this, folks. You've got 118% in volatility, and the 27.5 is going for $1.12. Now, next week's are $1.20. The May's is, if they don't have the 27.5, but they got the 28 for $1.04. Look at the difference as this thing drops down in terms of its volatility. Okay, now there is a way to kind of trade that volatility. You can go out there and buy this $26 call option and sell this $28 call option and create a $1.50 debit spread, or debit diagonal, and basically go out there and place this trade to take advantage of premium, okay, that you can actually collect the premium. But in terms of the other strategies or the other trades, selling puts on these, I'm not a big fan of any of them right now in selling puts. The only one that would be, like we said, like we mentioned, would be the Facebook one after the earnings are done. Okay, Mike. Again, the probabilities have to be in line with you having a higher percent of being successful, because you are risking a lot of money in the trade. That's so important. So awesome, beautiful, good. That's a great question, though. I love selling puts, and so if I was going to go out and sell puts, I would want to see a little more of an upwards tilt without earnings in the way. So, for example, like SBUX, not gold, SBUX. Why is this? There we go. Come on now. Just typing it in too fast, and see, Starbucks is a beautiful uptrend, right? So when you look at this and you see the uptrend, that's the most ideal candidate. The most ideal candidate to sell something. And then what you want to do is you want to look at your SBUX, and then you want to say, okay, well, I can go out and sell for the June, and I'm going to get 91 cents for the 57.50. Well, what's that? That's 1% would be 50 cents. So this is about 2% in an uptrending stock. I would rather get 2% uptrending than 4% downtrending, because my probabilities here are better. Now, the premium isn't really up to snuff as high as I want it to be, but we're getting better. We're getting into an area where basically I'm getting about a 2% rate of return on the strike I'm selling in a stock that's in an uptrend. So that's a little more of an intriguing factor for me. The question from Marianne is Facebook's earnings are today, I believe, at the close, right, guys? Everyone want to confirm today's close? Yep, thank you, Mike. Yeah, today's close. Thank you, guys. If there are any other questions, folks, make sure you put them in, and I'll be more than happy to answer them. And then I'm going to go through a couple of stocks that I think are in fantastic uptrends that I think have a good possibility to continue. Disney, beautiful uptrend. I like it a lot. It looks good. It's got earnings coming up, so wait for the earnings to get out of the way, and then once earnings are out of the way, then look at possibly getting into this here. I'm liking the overall chart on Disney. It's just been humming along. It has cheap options, so you can go out and buy a June call for about $2.40. After earnings, I'm really intrigued to get back into this. So Disney's on my, intermediate term long, or bullish position. Costco's the other one. I did chat out today. I'll close this up just for a second, just so you can see this. Oops, sorry. Default. I just want to show you my layout. Come on. Where'd the layout go? All right, so I lost everything now. Main chart. There we go. There's the main chart. Pause that. My feed. There it is. Okay. That's not the feed. There we go. So Costco, and I'll make this a little bit bigger in a second. I just want you to see Costco setting up for another bullish entry. Starbucks building a bull flag. So two of the stocks that I'm really intrigued to look at on top of Disney is Costco. It's got this little bit of a pullback here. And Starbucks, SBUX. These are stocks, all of them I'm looking to just go directionally long, which means I'm buying a call, outright. And those are kind of some of the stocks. Home Depot's the other one. Not HEHD. This one's got a nice little bull flag tailing off there. And, when I see that, it's telling me that there's a possibility that this might take another, push higher. So I'm typically looking at each one of these being a 3 to 4 week trade. So probably buying June calls or puts. June calls. Question is from Brian, what about selling puts on Disney, Starbucks? Yep. So I'm seeing a little bit of an upside potential here, Brian. And so I think there's a little more upside potential to both of these, but there's nothing wrong with selling puts on either. The premium, right now, premium is very cheap. So if you look at both of these and then you look at selling the premium on them, selling Home Depot for June, $70 strike, you're going to get less than 2%. Okay, because 1% is 70 cents, 2% would be 140. Disney, we're looking at the June 60, which would give me less than 1%. Okay, premium is very cheap, so finding the most ideal candidates for selling puts it's tough. You've got to really pinpoint. I mean, you've got to be shooting a bazooka with the accuracy of a sniper rifle, so because you've got, you got to be really careful here. Starbucks out to June, we talked about this already, we're going to get less than 2%. So each one of these stocks that I like for an uptrend, Brian, are all not giving me good premium. And that's because the volatility index, the VIX, is showing us very low volatility. And because of that, we're getting very cheap pricing. So Michael's strategy of selling puts is a wonderful one. The issue is that we're getting very, very low premium right now because of the market conditions that we are in. Okay, so that's something we really got to be considering while we're looking at what we're going to trade. So what I'm looking at basically is I would rather go more longer term. Be more bullish, buying calls outright. When you think about Starbucks, or if I look at Starbucks again, and why, when we kind of just said, I answered your question, why not sell puts? Great idea. The only thing is that we're not getting a lot of premium. So we've got to kind of dovetail both pieces of the puzzle. Great premium, and uptrending, and we're not getting great premium. Uptrending stock, we got that in place. So what I'm looking for is this little pullback here of a bull flag. Oops, I missed it. And then talking about, a move of about $3, right? $3 when it breaks above here. So when we get a $3 move up and buying a call option, we're just going to take the quick ride. The other alternative is, if you don't want to do the quick buying of a call, you can say, well, you know what if I sell the put spread? But even the problem there is, because again, we're selling the premium, Brian, we're not getting a lot of juice here. We're getting a decent amount. I mean, we're going to get 50 cents on a $2.50 wide strike. So it's not horrible, it's not horrendous, but it's not great. So it's going out doing the directional calls, which is what I really need to look at, is the directional trades. Okay? Because again, premium is the absolute factor here in what we need to look for. So Disney, Starbucks, Costco, Home Depot, all looking more directional. You got it, Brian. I'm going to send that back right out to everybody. Buy cheap IV and sell high IV. You absolutely right. Absolutely right. We sell a lot more of the higher volatility. Now, what I was mentioning, though, is how you can do a little bit of a hybrid of that. And what we talked about was the IWM going sideways here. And so with the IWM, more in a sideways trend, then, how do we take advantage of the sideways trend in IWM? Well, sideways means selling something because it's just going to go nowhere, and collecting premium because it's, we've got this, sideways movement, and we don't want to give upside potential away. So you don't want to, like darn it, I wish I didn't want to sell that put, or I didn't want to do a covered call. I miss all that upside potential. Guys, you really want to look at focusing on moving the needle in your account. And what do I mean by that? I mean, does anyone ever realize what 2% a month does to your account? 3% a month does to your account? I mean, 3% a month is 36% a year if you can sustain it. That's doubling your account every 2 years. So 2% divided by 70, they call the rule of 72. 2 into 72 means that every 3 years, if you're doing 24% a year, you're doubling your account every 3 years. People always get enamored with these giant gains. And there are some people in here that I've taught and been working with for years, and they can all I guarantee you, every one of them that's in here can say, Ralph has never showed me a 2,000% trade, because I just don't trade that way. I trade a lot more consistent. And so when I'm looking at that, why I'm talking about this is, well, what if I was to sell some premium for 10 days from now, out at the 92.50 range in IWM, and then buy this like 91. Okay, so here's a trade that's $1.63. Okay, I'm going to have about probably 3 rolls or 4 rolls. I can actually go out to the June one. It'll probably be a little bit better. So I'll have roughly, in terms of selling premium weekly, like a covered call here, the June option means I'm going to sell 1, 2, 3, 4, 5 weeks into it. So on $2.50, divide that by 5, I've got to collect 50 cents per week. Okay? Well, right now, I'm collecting 90 cents. So I'm above that break even that I need to be. All right. So with this type of trade, all I care about is selling premium, and it's basically a trade that's going to cost me $223. So I'm going to do this 5 times. What I'm doing is I'm thinking of the IWM staying a bit sideways. I'm going to throw this trade out there at 5 diagonals. But let's set it up this way because I want you to see what happens when we put the trade on and what happens to my Greeks. So let's do this as a 5 call. Let's sell 5 buy 5 calls for June. Get that filled, and then go look at the account and show you what's going on here. Okay. So here's the account, and here's IWM. I've got 5 directional calls in here, 5 bullish calls. Okay. It's giving me a delta of 288. That's like effectively saying I'm long 288 shares of stock. Okay. Now watch what happens to these numbers. 288, 37, 15, and 55. 52. All right. I'm going to go sell this 9 days out like we talked about. I'm going to sell 5 of them. Now watch what happens to my numbers. All right. 288, 37, negative 15, and 52. Send. Boom. Now look what I just did, folks. I just turned 288 shares long into 70, and I turned a negative 15 theta into 11, which means I'm going to collect time decay every day, and I'm only long about 74, 75 shares of stock. So I've greatly reduced my long exposure, and I'm collecting time decay. And if you want to see how this actually works out for an account, well, I've actually got one of these trades right here. Here's the spiders. Folks, I am wrong. I'm absolutely wrong. It's above the strike price I sold. I sold at 157. It's at 158. I'm down $125 today, but I've made $550 on this position. I skewed it a little bit where I sold 3 against a long 5. So I'm long 5 calls and sold 3 against it. So I had a bit of a bullish bias here. But still, here's where I am selling premium and collecting time decay every day going by. Now, obviously, it's gone against me, so I'm about break even on this side of the trade. Okay, so I've given back profit. But it's a profitable trade even though it's gone against me here. And that's what I like about a higher probability trading strategy. So here's where I am selling a call against another call, negating the whole idea of even having to own the stock. Okay, so I didn't find a very good trade there with the directional, with the selling of a put outright with some of the stocks that came up. But what I do like is the IWM sideways, and if the IWM sideways does anything similar to what we've got going on here with the spiders, then we're going to have a nice little profiting trade here. Okay? It's getting close to me what's called rolling the trade to next week. Right now, the options come out. Actually, they're already out. So let me bring that over so I can show you. I can roll this because what I love about what they've done with the weekly options is that they already have next week's already out. So what I can do is I can sell and collect another 50 cents in profit, folks. That's 50 cents times 3 stinking contracts. Let's go out there and click on this and just dump $150, boom, right into the account. So there you go. We just got rid of the 157s that are in the money, and I sold the other 157s that are in the money. The likelihood that I'm going to get called out are very slim. Okay, again, make sure you do your own risk analysis on placing these trades and you don't just go off of what I've said. If this goes up, this is going to go against me, but my long calls are going to be in my favor. Okay, and since I have 5 long calls against 3 shorts, I'm going to really do pretty well here. Okay. Are there any other questions you guys have? I have one more from Mike that I want to bring up. Michael also brought up he is bullish on a stock, CLAX. Let me minimize this. And again, like, see, Mike, what you can do is you can actually send me this chart right through the dashboard here. CALX. So this is a stock that had a really nice uptrend, and now it's kind of gone a bit sideways. It was making higher highs and higher lows, you know, all the way up. Here's the higher high. It came down. It broke the trend line here. Right here is where it should have bounced higher. Well, it went lower, and then it came up and made a lower low. So now we've got a lower high and a low, and we've got a lower high and an equal low. So it's starting to break down a little bit, and if this is going to be more of a bullish stock, then I need it to stay above $8. If it starts breaking out of $8 and even the $7.90 range, you're breaking some serious areas of support. I mean, if you look back here, this area right through here at $8 even, it was resistance. Broken resistance, new support, broken support, new resistance, broken resistance, new support, came down, bounced off it higher, bounced off it, bounce, and now it's just hanging sideways. This type of sideways trend would lend itself to another non-directional trade like a calendar or diagonal. I don't know what type of options this has. CALX. And it doesn't have weekly options, so already it's not in my favorite book. And it has very cheap options, so I can't sell anything in it on it either way. So not actually something I could sell. Why not do a calendar on IW? Okay, so Brian's question is, why not do a calendar on the IWM and not what I did, which was a diagonal? Because I have a bias tilt to being a little more bullish. And if I have a tilt either way, I do a diagonal. I'm a fan of doing diagonals mostly anyway, Brian, because if I need to roll it down, I can always turn it into a calendar. And again, I do cover more of this in classes that I do, but all the ins and outs and everything of every piece and nuance. But the great question. I like diagonals from the standpoint that they allow me to roll it into a calendar, and if I have a bias in either direction, I tend to look at the diagonal anyway. So CALX is something that was in an uptrend. It's now going sideways. It's not a good candidate for any sideways type of activity. It has very, very bad options to trade. And then the other one is AVP. Not Apple, AVP. And so AVP, here's a stock that's in a nice trend upwards here. And so I think the question was, when selling puts goes wrong within the case in AVP, last fall. Okay, I rolled the short 19 for several months. Then I got nervous coming up to earnings. Yep, covered my position. Big loss, hindsight. So the question he's asking is, he was wrong and he was rolling the trade from month to month to receive credits to help reduce reduce the loss. Good idea. When it gets to earnings, yes, you can attempt to skip over that and sell the next month out. Okay. I That's why I do like doing these on ETFs more. Because you don't have to worry about the earnings announcements. That's why I showed you one on the IWM. It's not that I don't do them on stocks, but I prefer to do them on ETFs because I don't have to worry about the earnings. So the question that he really is asking, thank you, Mike, appreciate that, and I'll share it with everybody, is that trade management question, when to stop rolling. Okay, you've got to find an area of support. So let's go back to IWM because that's a trade we just did, and I'm going to look at a few things. Okay, number one, I've got support. I've got a few areas of support I can look at. I can look at this significant area of support right there at $89. Okay, I can look at the whole move on a Fibonacci retracement, and I will find some areas of support and resistance. Okay, so I can see that my line is an intermediate line that's not hitting the areas for the fib, but I could say, all right, you know what though? In order for my support line to be hammered, it's got to go through another area of a Fibonacci retracement. So if I can get two lines in between me and being wrong, which means the second line is the area that I'm going to get out on, this gray line. So there's my two areas, and I'll put my stop loss just below there. That's where I'll get out. And the reason for that is I've collected premium. So, you know, when I'm collecting premium on a weekly basis, for example, on that IWM trade, I'm collecting 90 cents. I need to collect 50 for break even. If I'm collecting 90 this week and I collect 90 next week, and the entire trade, the entire out-of-pocket expense on that trade, let me go back to it so I can show you. The entire out-of-pocket expense on this trade was $253 minus 90 cents. So that's $160. So I've got $160 of risk in this trade, right? So if I collect another 90 cents next week, I've got, what, 70 cents of risk in the trade? So because I've got such a small amount of risk in the trade, I'm going to let a couple of two support lines break, you know, and I'll get out. So when you're looking for a stop rolling is, number one, if the trend is breaking, and the trend's going to break when you break support or you break resistance, right? So your question, or trade management, when to stop rolling. When you look at, you got to look at the premium you've brought in and look at the amount of risk that you have left, and you have to look at breaking support or breaking resistance, okay? So, you know, when I look at my IWM trade here, let's say that this goes sideways from here. I collect another, let's say I collect 70 cents or 60 cents. And so now I have $1 risk in this trade. All I could lose is $100 on 5 trades or $500. And then I roll it again for another 60 cents. So now I've got I only got 40 cents of risk. And now I'm getting down to my area of support. Okay? So there's a bunch of answers here, Mike. So it's not just one, because you've got premium, you gotta rely on how much premium. So now let's say I get down to this area of support, and now I'm thinking, all right, I got to get out. But I can roll this for another 50 cents right now. Then I'm thinking, hold on a second. If I'm looking at this trade, and it'll be helpful if I bring up an Excel spreadsheet and show you this really quickly. If the theory is that you've got $2.60 of loss in this trade that you can take on, right? Because the trade actually is 250 minus 90. So we only got $160 of risk in this trade, okay, or $1.60, whatever amount of contracts you do. If I roll this for 60 cents, okay, now I've only got $1 risk. And then next week I roll this for another 40 cents. And now I've got only 20 cents of risk, Mike. and now I'm down to my area of support, and I'm like, man, what's going to happen here? If this goes against me, I've only got 20 cents of risk, $20 of actual real risk, okay? And I can go collect another 40 cents. So I sell that 40 cents at support, okay? And now I'm at a plus $20 or break even by the time you look at all the commissions you pay. I'm okay with a little bit more wiggle room on that area because now I can't lose on this trade. All right, there is no loss I can take on this trade because the selling, anything I sold is going to expire worthless. And if this keeps going against me, my call is going to expire worthless. Okay, but if I can keep collecting this type of premium, and now I'm at a break even or positive, I'll give myself a little more wiggle room to let that support line break a little bit, Michael. But if I'm at a loss and then I'm breaking support, now you're just compounding your loss, compounding the possibility of even a bigger loss. So there's a few different areas of possibility there. Where is the stock, up, down, sideways? If it's going close to that support line where you should get out, but you've collected enough premium to allow the trade to be at break even, then you can say this really isn't going to cost me anything. So maybe I'll let it run a little bit more. Because if you were willing to take a $160 loss to begin with, and now you're down to possibly having nothing but break even as your worst case scenario, then when your worst case scenario is break even, you can let it ride a bit. You know what I'm saying? But you've got to, unfortunately, it's kind of a give and take, and it's a little bit of a feel to really what's going on when you physically roll these things. And Marianne, hey, how are you, buddy? Good to see you. His question is, I just got into the Facebook. He's actually going in before earnings and going to take advantage of trading an earnings double diagonal. So he's going to take advantage of that high volatility for Facebook with that 118% volatility, and basically hope that all he cares that happens is that volatility saps away. Really, if all that happens on Facebook is that volatility just goes nowhere. I mean volatility just sucks in because the news is out. He's going to be a quite happy camper because these options that expire tomorrow are going to be worthless. Like here, what did you do? You did the May 3. Okay, so let's just kind of do a little tester with him, right? We'll go out there and do the 28. We'll sell the 28, and we'll buy the June 26. We'll do that only once, just to kind of get an idea, and we can revisit this next week. And then I'm going to go sell the 26, and then go out to the June and buy like the 28. And I'm only going to do this once. So I got a double diagonal. I'm kind of following along with Marianne's position. There's the Facebook. Let me go over to the account here so you can see it. There's the Facebook. Earnings are going to come out, and let's see what happens, with all this volatility. Okay. The American Express trade is doing very well for us. Very happy with the outcome of this. We bought the option a couple of weeks ago in this session, by the way. For $5.90. It's worth $8 and change, and we did that 5 times. So we're making almost $200 per option times 5 options, right? So we're managing this position from an area of winning, And what I like about American Express also is that it's setting up for another bullish position. So we can look at this and say, you know what? If American Express continues doing what it's doing, then we should look at the possibility that it's got another run in it going to the upside. And again, please, folks, please make sure you do ask questions. I'm not here to hear myself talk, but I'm here to help you be a better trader. So here's another chart you can look at. You can see this bull flag, which is going to give me about a $5.60 move. So we're still in the American Express trade. We're managing it from an area of strength. I should put a stop loss in place if this thing gets down below $67 and change. And we're looking for another $5 move up. Okay? So just out of curiosity, folks, what do you want? What would you look for? What type of trade would you want to put on in American Express if we're looking for a $5 move over the next couple of weeks? Let's call it 3 weeks. So we're going to look at maybe, what type of trade would you like to look at? Anyone? And Marianne, thank you for that. Michael, thank you for your trade, for your questions, and Marianne, thank you for your trade. I did a little bit different, but still the same logic. Paul saying bull put spread. Brian saying a bull call spread. Well, we know you're bullish, right? So if we're going to do that, the bull put spread, again, premium is not really going to be a and George, he's looking for a long call. So thank you guys for your questions. So it's 34 cents to risk $2.50. If we go out and do the long call, the call debit spread, we're looking $2.50 and risking $1.78. So we can make $72 on this trade, or we can make $32 on this trade. So let me tell you why I don't mind either position, but I prefer the long call more in this position that we're in. Volatility is very cheap. The June call for American Express is at 19-20% volatility-wise. Earnings are out of the way. Earnings were last week. Okay, so we don't have to worry about earnings. I've got very cheap volatility. I've got very cheap options, and I've got about a $5 move. So in both of our other trades, we're risking about $200. What if I was to risk about $200 in this trade? Okay. Now I'm looking for about a 3-week move, so let's just go out to the 24th, $5 move up. Our June $4 option would be worth $8.30. So we've got a $4 upside potential, and if this does break down through that $67 range as a stop loss, I am risking right here to be worth $2.65. So $4 minus $2.65 is $1.35 or $1.40. So I'm risking $1.40 to make $4. So I'm risking less with a less probability, but I've got a higher rate of return if I'm right. Analyze duplicate position. If I look at this, analyze this duplicate position on AXP, I have to hide the position I'm in because we already are in a position. We're looking at this for this May time frame. We've got a 40% probability versus a 60-something% probability on the other trades. So in the spread positions, we're looking for a 60-something% probability of risking 2 to make 50 cents. Here we've got a 40% probability of risking $1 to make $1.40 to make 4. So there's a nice upside potential here with this. Now, it has not set up yet. Okay, so I'd be inclined to come out here and look at this June 65 call and set it up if the stock breaks above. So what we're looking for, folks, is we're looking for American Express to continue in its uptrend. And if Amex continues going higher and gets above basically the area of resistance at $68.50-60 really, if it gets above about today's high, then we're going to be able to enter here. So in terms of some positions we're looking at, Costco, Home Depot, Disney, AXP, Starbucks, 5 long positions on stocks that I think have some upside potential, and I'm looking to go directional on every one of them because premium is so stinking cheap right now. There's nothing wrong with looking at the spreads. I'm just not getting a lot of premium, and I'm not getting a bang for my buck. Right now, the biggest bang for your buck is when you're looking at a series of trades, and I'm looking at basically being more directional than anything else. And when I'm looking at that, saying, okay, you know what? If I'm going to put 10 directional trades on, and I'm going to be right on 4 of them, I'm going to be wrong on 6 of them, and when I'm right, I'm going to make $3 or even say $2.50. And when I'm wrong, I'm going to lose $1. So in terms of really what we've got here is after a series of 10 trades in a month, I'm going to lose $600 and I'm going to make $1,000. So I'm going to end up making $400 or $4 on my 10. So if I'm going to risk $1,000 and return $400 for that month and do things that have 40%, where I'm right 40% of the time, and I'm risking $1 to make $2.50, and I use these parameters, because options are so stinking cheap right now, I would rather look this way than at the vertical spreads. So Marianne is bringing up the YHOO. You looking to go long on YHOO? And of course, there's another nice long stock. It's got a nice bull flag. It hasn't broken out above. It's still possibly going to give us an entry. Not yet. So let's go look at the trade here on YHOO. Again, options are going to be probably really cheap here. A June option is going to cost you $2.50. I'm going to reply back. There you go. That's what Paul just wrote back to me. So another stock, again, YHOO. Then ding, 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 there goes the bell. That, again, looking at a really nice, strong uptrend. And I'm looking for a break above to pop in for a long position. And again, looking to do more directional because options are so stinking cheap. And so, your response, Paul, is exactly. That's why when I'm looking at this type of analysis where 10 trades, winner, loss, and then we're looking at a 2-to-1, 2.5-to-1 risk-reward ratio. Even if I'm at a 2-to-1 risk-reward ratio, folks, and I make $8, I'm still making $200 a month on my $1,000 investment. Okay? And I only have to be right 4 out of 6 trades. Sorry, 4 out of 10 trades. All right? Now, preference-wise, I love 3-to-1. Because 3-to-1 even allows me to be wrong even more. Now, most of the people in this room are men. I don't know how many of you are married, but I am, and I know I'm always wrong. So, just kidding. But if I'm wrong, and I only win 3 times, and I lose on 7, then I make 9 and I lose 7, right? So I still make 200 bucks. So I can only have 3 winners in a cycle of 10 trades with a 3-to-1 reward to risk ratio, and I still profit on a monthly basis. Does everyone see why long calls right now are, and if you find stocks that are bearish, long puts, because the premium is so cheap, why I like going this route right now. And to that point, why I like doing the diagonals is because I then negate the premium. I'm selling premium and I'm buying premium, and I'm getting it at a relatively cheap rate. So I'm collecting premium monthly like a covered call without even buying the stock. But YHOO's another one. That's a nice stock. Marianne, I think, there's another really nice tradable stock. You got to move from about 22.90 up to about 25.30. So we got a $2.40 move here in YHOO if it continues in its uptrend. Are there any other questions, folks? There is one other one I think I wanted to get to. I think I got to it. So let me see if there's any other questions that pop in there. So this question actually is coming in. I have the long 44 call in the June and the 45 short call for May. So he's a diagonal on Citibank with the underlying price at 46. So with the underlying price at 46 and he sold the 45, he's actually got an in the money call. It could continue to climb. So right now it's at a really nice rate for continuing to write that covered call and sell the premium. The underlying price is 46 and could continue climbing higher over the next coming weeks. Should I let the May expire? So I would think that you want to roll this, okay? And I would be looking at taking Citibank and rolling, because they do have weekly options, and rolling it out to the same strike price. So this trade is selling the 45 call against the 44 call. I would have no problem going right back out there and selling another 45 call and collecting premium. I never really like to let things expire when they're so close to the strike price. So when I'm selling things, I like to roll them, which decreases my odds of having it put to me or having me do something I don't want to do. Okay? Now, folks, if you guys have any questions, please make sure you email me. All right? You can always get in touch with me right here on my email. And if you guys, I know there are a few new people in here. If you're on your trial, please make sure that you, consider becoming a part of our membership here. It's $80 a month for 4 hours of coaching plus email support. And of course, we're doing a promotion where the first 3 months are at half price. So you're talking about $40, folks, for a month. That's $10 a week to get some serious good advice, or good analysis of trades and trade setups. I mean, our AXP trade is making $200 an option contract, so the proof is there. So, I really would implore you guys to get involved and become a member and look to join us on a more consistent basis. And if that is something that you want to do, I can send you an email so that way you can you can join us. Or what you can do is I'll put the link in here for you guys so you can do it yourself. Okay? There is I have everything set up through PayPal. So you guys are, you don't have to worry about anything everything goes right through PayPal. So all you need to do is just take this link and send it in to PayPal. All right, just open it up through PayPal, and you can basically, use this to get that offer that I talked about, okay, which will allow you guys to come in and work with me, just so you can see what the offer is. Here it is right here, as if I was going to go open it up myself. It's $39 for the first 3 months and then $79 a month after that. All you need to do is just open that link and then get it going. Okay, and then obviously you're going to get the email support plus the 4 hours, the 1 hour every week. And I do have one other question for everybody. In terms of preferential time, what day and time works better for everybody? I've been getting a lot of emails back and forth to change the time, to change the day. Just out of curiosity, of the people that are here, what days work for you? You know, do you guys like evenings better? Do you think maybe if we do an evening session, would you guys prefer that more? Oops. Just out of curiosity, is a Tuesday better, a Wednesday better, a Thursday better? Okay. Yes, Marianne, that's where you know me from. Because the thought is either, you know, I mean, the Tuesday or the Thursday. Wednesday seems to be pretty good, but I've got people who want, you know, Tuesdays, Thursdays, 4 o'clock in the afternoon, right as the market's closing, just to kind of do a wrap up. On Thursday seems to be a very popular one. Any day other than Monday and Tuesday, Ron. Okay. I'm going to send an email out to everybody as well, so you don't have to, you know, you can stew on it a little bit. Because I want to make this the most effective use of everybody's time. Even if it was Wednesday in the evening, I don't know if that would work for everybody. Well, Facebook's numbers came out, by the way. Because you know, we're not doing anything that has to be done during market hours, and that's what I love about this. This isn't day trading, which is the lowest probability of stock day trading. Traders are the lowest probability traders of anything out there. Forex day traders have a much higher probability of being right, actually, and that's why we actually offer it. Let's look at Facebook. So there you go. See, we're getting this 30, 40 cent move. So let's see what happens with the earnings now. So yeah, I'll send you guys an email, and then you just respond, and I'll kind of, you know, see what works best for everybody. Are there any other questions for me? No, Ron, it's always 3 p.m. Eastern start time, 3 to 4. If you look at the registration page through go to webinar, it shows 3 o'clock. I can show you everybody email as well. Where is it? Hold on. Go to meeting. There we go. So this is an email I sent myself to register. Join us for the, you know, for webinar beginning May 1 at 3 p.m. And if I click on this, it'll bring me to the registration page, which will show me the 3 o'clock. There we go, 3 to 4. Thanks, Mariano. I appreciate it. I don't know what you mean about the no though, so I'm not sure if what that means. But I'll send everybody an email finding out what time works best for them, so that way I can accommodate the most amount of people possible. You're absolutely welcome, Mike. I appreciate the trades that you brought in. I wish I had better setups for you, but I do like the those long positions right now. I'm really happy with the long positions that we talked about with Disney and um, um, Costco, Starbucks, Home Depot, and now YHOO, courtesy of Marianne, bringing that to us. So, all right, folks, if there's anything else I can do, please remember to send me an email. And again, if you're on the trial, again, I can highly consider that you would want to continue with us as we move forward. We've got a lot of trade ideas. We've got a great community of people, and I certainly enjoy working with you. So everyone have a lovely afternoon. Randy, if you're still here, give me a shout. I know we got to talk, so give me a call, and we can catch up. All right, folks, thank you again for all your time, and safe trading. We'll analyze that Facebook trade next week, as well as the rest that come in. I'll talk with you soon. Take care, everyone.